All right, last topic. Although not the last lecture, there is going to be a lecture next week. We'll talk about that momentarily. So topic 12, we're looking at cash flows. Before we get into that, there's some admin and just some various bits and pieces we need to cover. Topic overview. Cash flows is a slightly different topic to the extent that it's in a way not dealing with accounting numbers. I mean, there's certainly numbers in an accounting statement, but what we've looked at over the last 3 or 4 months is a way in which accrual accounting works, and cash flows is very different to that. So we're going to be looking at the definition of things around how it's a performance measure and what information it provides and why it's useful. We'll then look at the regulation of cash flows, which very much focuses on disclosure and presentation. That's the key things that we're looking at there. Not surprisingly, cash flows, keeping everything fairly logical with accounting, cash flows are just cash flows going into the business, cash flows going out of the business. Cash flows are inflows and outflows of cash and cash equivalents. So the formal definition is, not surprisingly, what you'd expect it to be. Although, we're starting to see something a little bit different down here. There's something called cash equivalents. If we remember back, it's going back a little while now, but if you remember back to Statement of Accounting Concept 2 about information and the way people use accounting, it's to make decisions, or at least primarily that's what the regulators see it as. So to help you do that, these are the things they see which are important. So performance, position, financing, investing, sort of where you're getting your money and what you're doing with it. And the Statement of Cash Flows arguably provides a lot of that information. Now they do both cash flows, and we looked at the income statement, maybe not explicitly, but when we've done profit, when we've done revenue, we've kind of loosely talked about the income statement, and that is just, revenues minus expenses gives you profit. And the idea behind profitability is it is information on performance of the particular company. And we know that information on performance is useful. But there are things which are not quite the same. So what we have here is, imagine a situation, and this is it's not an abstract company, but it's simplified in a huge way. Imagine a service company which has absolutely no expenses whatsoever, 0. They make $100,000 worth of sales during that year, or they perform $100,000 worth of service. They are able to collect $95,000 of that during that particular period of time, which means they've got $5,000 outstanding. Now, their income statement is going to show $100,000 in profit. Again, they've got no expenses. Good luck to them. And their cash flow is going to show $95,000 positive cash flow because they've only collected $95,000. Those things are pretty similar, but not quite the same. But the difference, and what we're going to look at in a second, is quite important. So from a mechanical point of view, if you imagine on the left-hand side, we've got profit. And so that could be your income statement. And we've simplified it in this particular case, but that is statement of financial performance. You got it, revenues, expenses, gives you your profit. On the right-hand side, we've got cash flow from operations. Now, you guys have looked at cash flow statements before in first year. There's operating, investing, and financing cash flows. So the operating cash flows just relate to, funnily enough, operations. Now, profit in this case is $100,000. We've had a change in an accrual account. So accounts receivable has gone from 0 to 5,000. In this particular case, we take that away. And what we're left with is cash flows from operations for this particular company of $95,000. Now I'm going to give you just, not so much a scenario, but just a bit of information, and then I want you guys to think about this for a second and come up with some ideas around it. We know that there are incentives for companies to manage earnings, to do things with this number. So this is their income statement, that's their profit. And we know that there are incentives around them. And not every company does it, even if there are incentives. But we know there are incentives to do things in that particular space, whether that be push profit up a little bit, push it down a little bit, whatever. This, mechanically, the difference is based on this profit figure, if you think about it, if we kind of push this to the other side. So this is driven by what your cash flows are and then what you do with your accruals. So my question to you is this. If a company wants to manipulate its profit, is it easier to do that with this number, the cash flows that it receives from its clients, or various other cash flows that are going on, or is it easier to do it with the accrual number, which is sitting there? Yeah, it's easier to do it with the accrual number. Outside of absolute fraud, that number is what you see. You can't, unless you just want to literally just go, well, we didn't really get $95,000, we're just going to make stuff up. Think about what other sort of accrual numbers sit in there. Depreciation is an accrual number. You change your depreciation useful life. You change it from 10 years to 15 years, you have dropped your depreciation expense. You change provision for long service leave, you change some of the inputs in there, and you change that expense. You play around with financing and operating cash flows. You change around with things, and you will change this number. The cash flows will be what they are, but you can change this number, and that will mean that the profit that you show is different. And that is why a lot of people don't necessarily trust accounting numbers. Because cash, this idea that cash is king is quite prevalent, that you cannot manipulate cash. Yeah, sure, you can sort of say we're going to get cash in it. You may sort of push suppliers to get money in from them earlier, or sort of maybe say don't hold off on paying us till later. But to actually just change the number that comes in, you can't do that so readily. So it's this number where a lot of the problems lie. And to give you a sense of how big some of that is, this is Qantas's 2013, I know it's a little bit small, 2013 profit. So their profit for the year was $6 million. Now what's happening here is they're reconciling profit to cash flow from operations. Now I know it's a little bit hard to see, but the biggest one line, like by far, is depreciation and amortization, is nearly $1.5 billion. So that line item is a profit number, but is not featuring in cash flow from operations. And you can change that by simply changing the residual, estimated residual value, by changing the useful life. Like you can change those things. And Qantas have changed those things in recent history. So it's not like it doesn't happen. And it's not, that's not to say that it's wrong. I'm not saying that at all, but it can be done. So accounting numbers have been subject to criticism. Income numbers are a function of performance and accounting policy choice. So it's not just that the number you see in profit is just actually how they're operating. It's based on what they're actually doing and then how you account for it. And those are not necessarily going to be the same. So think about it, and it's a good time to, it's a good time to, I suppose, reflect on this, given that the time of year that we're coming up to is accounting is a model of reality. It's not, it cannot be everything about a company because these companies are generally quite large and we pretty much get it down to, at least if you think about the profit and loss statement, one page. And a company like Woolworths has like $1 billion of sales a week. Like we're making simplifications to what goes on. But on the same token, and so think about this in your context. In a couple of weeks' time, you'll sit and do our exam. In a few weeks, or however long it takes for the university to sort everything out, you will get your results back. Now, what we're trying to do, that result is not everything about you. It is, hopefully as best as we can do it, an efficient representation of how you have performed in the subject. Now, we'd like to think, and I definitely think this is the case, we're not being opportunistic in it. We're not changing that number based on, do we like a person or not like a person. So, people that we like, might get a higher mark. People that we don't like get a lower mark. That doesn't happen. What we'd like to think is how you perform is going to be represented efficiently in in what ends up there. But what would happen if you were the one who got to represent on your marks? So if you got your subject marks at the end of the semester, well, how many people do you think would fail this subject if you were the person that came up with your mark in this subject? Yeah. No one would. Unless you really wanted to come back and see me again for another semester, and maybe there are people that want to. Hang on, let me write that down. There's your paper. You know, maybe people do want to sort of come back and sit through all this again. But if you think about it from a company perspective, companies are the ones who are providing this information. And they're the ones who've got incentives to provide things in a certain way. And yes, there are checks and balances, and those checks and balances for the most part work quite well. So it's not as simple as saying, look, just here, make up your own mark. There is, you know, there are sort of ways to enforce what you should be doing. But the idea behind cash flow is we know that there are these choices and these incentives within the accounting numbers, so let's show another way in which they can't manipulate it as well. And that way is cash flow. So a couple of quotes. This one's a little bit old, from Michael Evans over at AMP. We try to identify the discrepancies between what the company has reported and what their cash generation is. Because you're wanting to try to figure out what this company is doing, and you know, ultimately it will come down to cash. You could be making profits left, right, and center, and if you're not generating cash from them, there's no real point. So ultimately it will come down to how valuable that company is, how much profit, how much cash they can generate in the future. And this is, I wish I could actually remember which article this came from, but this is from a research article from 2012. Investment advisors advocate comparing earnings to cash flow from operations and consider a wide disparity a red flag on the basis that cash flow is more real than earnings. So I just want to focus on this a little bit as to what's going on here. Okay. So the sort of thing that they're thinking of is, I'll run out of room somewhere. Okay, we'll just call that some sort of profit figure, net profit after tax, net profit before tax, whatever, just a generalized profit figure. And say it's gone up on a relatively steady line. Change this up. Okay, what they're talking about here is what you'd like to see happen. Lost it. Where am I? What you'd like to see happen is something, and it could be a little bit lower, it could be a little bit higher. This cash flow from operations over time, so this is, where is it? You'd like to see that over time be relatively well correlated. So I mean, if you've done statistics and you're sort of running through that, you'd be able to run a correlation on that, and you'd see that you should get some quite reasonable score of correlation between those two sets of numbers. Because what the difference is, generally speaking, between profit and cash flow from operations, sort of that gap there, is their accrual policies, is their accounting policies that they've chosen. So if you've seen some level of reasonable kind of togetherness, that's, generally speaking, a good sign. What they're talking about here as something which would be a red flag, and it's not to say that something's wrong, but it's something that you'd want to investigate a little bit further. What colour should we use? Green pickup. Is if you imagine it kind of tracking up and then starting to change. If it was tracking relatively well and then started to diverge from what's going on with profit, that's saying choices were made around about here that were different in terms of their actual accrual choices. So it could be they've changed depreciation, it could be that they've changed other things. It seems that profit is moving up fairly well. Now this could be there with cash flow from operations declining, that there's an actual underlying problem with the business and they are trying to keep profits afloat. It's a red flag. It's not to say that there's an actual problem here, but it is something that if you are looking at this company, you want to go in and see what's actually happening. What is driving that? So that's what they're getting at with that quote at the bottom there. But as much as cash is awesome, or perceived to be awesome, and certainly if you're doing finance, they very much focus on cash flows. They don't look at accounting numbers. It's not entirely true. because even cash flows and the direct method of calculating cash flows, which is the first line of the direct method for cash flows is cash receipts from customers. So you know, if I've only sold to you, sorry, what's your name again? If I've only sold stuff to Alex and he gives me $100, then I show cash receipts from customers $100. And I only found this out a few years back, but that's not exactly how they do it with cash flows. So they don't actually keep track of every single dollar that comes in, because when you're talking about multi-billion, multi-million dollar businesses, that's hard to keep track of, and systems don't necessarily work that well. So they actually do estimate cash flows. It's not as absolute as what you'd think. So even with this cash flow number, it's an estimate that's going on. Now outside of that, and this is sort of a bit outside the accounting, but you've got to hope that the actual accounting number, it's the number that they're showing, is legitimate. Now this is an example from a few years ago about an Indian company called Satyam. Some of you may have heard of it. It's a technology company. But the quote I'm about to show up picks up some of the problems, and you'd like to hope the auditors pick up on these sort of things, and the people enforcing this are aware of this and stop it from happening, but it still does. So Mr. Raju said on Wednesday that 50.4 billion rupees, or about $1.04 billion US, of that in cash and bank loans the company had listed as assets just didn't exist. So like they've literally just made up $1 billion worth of stuff. Now, there's probably not, that's non-existent, there's probably not a lot you can do on that, because that's not just accounting manipulation, like that's not just sort of accounting subjectivity, that's just out and out fraud. So that is different, but you do need to be careful about relying too heavily on exactly what people tell you. Make sure you are, hopefully the auditors are doing their right job. I don't know what the hell they were doing here. Obviously not that good a job. But you need to be careful what you can rely on. So the financial reports of the firm should be consistent. So when we're thinking about this, and it's probably a good idea, so I was talking to someone about this morning, of how all of this works together. So the income statement and the balance sheet, when we actually think of two balance sheets, they are linked by the income statement, because that's actually what happens. Because remember, the income statement are points of time, the balance sheet are points of time, the income statement is over a period of time. So let's have two fairly straightforward balance sheets at time 0 and a balance sheet at time 1. I'll change that color because it's not all that useful. Okay, so the balance sheet at time 0 is assets. We've got a company with $100 of assets. We've started a small business. Liabilities of nothing. We put in $100 of cash and shareholders' equity of $100. We then go and perform some work. We get some revenue, and we get $50 worth of revenue during the year, and we have no expenses whatsoever, and we have profit of 50. So this is our P&L during that period of time. Our assets are now 150 because we've got $50 extra cash. Or it could be if we didn't get paid cash and they owed us, we have $50 in accounts receivable, $100 in cash. Liabilities are nothing, and equity is now 150 because it's $100 of share capital and $50 of profit or retained earnings that we've made. So the way that the balance sheets articulate is through the profit and loss statement. Now, this is a really simplified example, because in reality, you've got other comprehensive income, there are other leakages which happen. It's not going to be as cut and dried as what you see here. But this idea that what you see with the balance sheet at the start, what you see at the end, there should be some linkage, there should be some level of consistency between it. As we just talked about, between the income statement and the statement of cash flows, there is going to be a mechanical relation between them, because once you strip out the non-cash effects, the income statement and the statement of cash flows should meet up in some way. And to highlight the point of consistency, I came across this example a few years ago, and before I put my foot in it, although my boss is a Kiwi, are there any Kiwis in the audience? No idea. So this was a New Zealand company that made a release to the New Zealand Stock Exchange in 2009, and they stuffed up along the way. I hope I put it in. They stuffed up along the way, and it actually deals with the reconciliation around net profit to cash. So this is in 2009. So literally in their statement, in the reconciliation to profit, they had put in the depreciation number. Explicitly, they need to fudge that number to make it equal to something else. And I'll put this link up later on. So they actually had, so depreciation, fudge this to equal depreciation in FA note 11, 2391, whatever. So they were trying to make sure that everything linked up. I mean, there wasn't any, like it was a harmless mistake. It was just making sure everything sort of rounded off. And I think they were just literally sort of rounded off decimal places and whatnot. But it's probably not something you want listed and then gone out to the market, because it doesn't set you and the accounting team in a very good light to have that go out. And fudging something is probably not the best way to explain what they're doing. But anyway, we want to make sure things are consistent. If you see cash flow, you want to see opening cash balance, a closing cash balance. The statement of cash flows should be picking up the difference between those. You don't want to see an opening of 50, a closing of 75, and a cash flow being positive 100. That would be weird. Things need to be consistent. So, cash flows and income are different. The information provided should be consistent. It should tell you a similar story. If you start seeing divergent stories, it doesn't tell you something is absolutely wrong, but it tells you you probably need to go and have a look at it a little bit further. If you're an analyst and there's opportunities for conference calls or asking management what's going on, then that's a good point to start raising with them. It could be something completely above board. Cash flow and income numbers are both associated with share returns. So we looked at income numbers previously. Cash flow numbers are also linked with share returns. So positive cash flows numbers will be seen as a good thing, negative cash flow numbers as a bad thing. Not for here and now, although if you want to start thinking about it, feel free. But coming up for the next 2 weeks, it's a good idea to start thinking about, well, what are the benefits and weaknesses of cash flow numbers? Why do we have them? And even, why do we have a cash flow statement? As we're going to see in a few moments' time, it's mandated. They have to put it in. But if you have a balance sheet, you can see the cash balance at the start of the year and you can see the cash balance at the end of the year. You can see the change. So why do you need a cash flow statement to show you the details of how it has changed? So again, something to think about. So we'll start pushing into this and take a break in a few moments' time. So the presentation of cash flow financial statements, this is going right back to AASB 101. And the reason we've done this is because, as I just mentioned, the statement of cash flows is mandated. They have to put one in. So a complete set of financial statements comprises, going to section D, a statement of cash flows for the period. AASB 101, paragraph 10. AASB 101, paragraph 111. Cash flow information provides users of financial statements with a basis to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to utilize those cash flows. AASB 101 sets out requirements for the presentation and disclosure of cash flow information. So looking at that and thinking about what we know about what people need accounting information for, and primarily that's for equity users to make decisions about the company. That's not to say we know that there are contractual uses and there are other uses that are in play here, but from the regulator's point of view, that's what they see it as. I just want you to look at that top bit in red. So it gives users a basis to assess the ability of the entity to generate cash and cash equivalents, because ultimately, that is what the game is about. If you're a business that can't generate cash, then you're not going to survive. And I'm going to talk a little bit about, I would say, it's not ancient history, but given that it happened at the turn of the century, and given that I'm a little bit older than I would say, a fair few of you in the room, it's probably going back a little bit for you guys. But we're looking at the tech boom, the internet bubble, and sort of people making supposedly a lot of money, and then the whole thing falling apart. So at the time, people were going gangbusters about tech stocks, like just going crazy about it. As a point of reference, because I'm about to talk about price earnings ratios. So price earnings ratio is just the price of the share versus the earnings per share. Does anyone have a sense of has anyone come across what you'd expect a price earnings average to be around for the market? Just in case you have or haven't come across it. About?
25,000.
No, it's a bit high. It's about between 12 and 14. Like so you know, you'd pay $12 for every dollar of current earnings. So that's basically what it's saying. So if you have a share price, if you have $1 per share, $1 of earnings per share, so whatever your total profit is divided by the number of shares you got is earnings per share. We've simplified that a bit. $1 earnings per share, you'd expect stock price to be around $12, $14 is roughly speaking what earnings is price earnings ratio. So 12 to 14 is about the long run historical average for most companies. You know, Australian companies at a point were getting up, to high ranges of $18 to $20. That was seen as, people getting a bit excited. For some companies, in this company, I can't remember the name, but I remember definitely, because I used to have a graph of it, it had a price to earnings ratio as a tech company across sort of 99, 2000. It had a price earnings ratio of 25,000. Where you consider that a normal price to earnings is between sort of 12 to 14, 25,000 is a little bit high. So people were going a bit crazy. Now the interesting thing about that price to earnings ratio is the earnings which was included in it was not even current earnings. That was forecasted expected earnings. That company was not making profit, it wasn't selling anything, it wasn't generating cash flow. And at the end of it, it all went belly up because it just wasn't doing anything. So at the end of the day, what people are interested in, what's going to make you money into the long term is this company going to be able to make money? Doesn't matter if it's making profits now. Doesn't matter if for these tech companies, if they're getting tons of page views or clicks or links or whatever. That is not what is going to drive overall business performance. It is ultimately, can they turn that stuff into profit? So if it's something like Facebook, when Facebook went IPO, they had to release their information, and Facebook actually makes a lot of money. Surprisingly so. It was about $1 billion of revenue when it went public. So it wasn't like it didn't make money. But Twitter and WhatsApp and all these other various things that have been bought and sold and are listed, I don't know how much money they make. Well, I mean, some of them we now know, but what are the earnings potential for these companies? Why are their valuations so high? Can they ultimately make money? Now, Facebook can because of the marketing behind it, and even though that's getting a bit painful to use it and people are sort of moving away from it a bit. But ultimately, can those particular things make money is where it comes down to. Okay. I'm going to show you two things. And actually, before we do this, you may remember something we did in week 1. It's going back a long way. Christ, seems like an age ago. But remember the experiment we did with the 15 letters I got you guys to remember? That sort of rings some bells? What the hell are you talking about? That was 4 months ago. Okay, because that was showing you 15 letters, try to remember it, and then show you in a slightly different way. It makes a bit more sense. It's a bit more memorable. The idea behind that is the way it's okay to have the same information, but it is how that information that is provided which actually becomes quite useful. So if we look at option A and option B, it is the same information provided. Absolutely the same. All that we've done is scramble it up in some way here and then set it out in terms of how its normal statement of cash flows would be presented. And what that means is, yes, we can tell it's positive on both cases, but for this, we've got to expend time and effort to figure out how we want it to put it together. So if we want to figure out operationally how this is going, we'd have to look through it and go, okay, well, receipts would be useful, payments to suppliers would be useful. That probably doesn't. We'd have to make decisions about that. The other thing that causes problems is if we didn't have regulation about how information was presented, then different companies could present things in different ways. And then that makes comparatives difficult. So by keeping things in a relatively uniform way, so we know when we look at an operating cash flows from operations, we know certain things are going to be in there. We know when we look at investing cash flows, certain things are going to be in there. We know when we look at financing cash flows, certain things are going to be in there. It makes our life easier to analyze what's going on. The definition of cash isn't a major issue. It's not to say it's not an issue at all, but it's not a major one. The classification of cash flows is an issue. So what bucket basically do we put it in? Is it an operating one, is it a financing one, or is it an investing one? And disclosure and presentation, like how you put this stuff together and send it out into the marketplace. So 107 cash flow statements is what looks at, surprisingly enough, cash flow statements. And we'll go through a little bit of it and then take a short break because we're making good time. So paragraph 6, the cash and cash equivalents. What cash and cash equivalents include are short-term commitments. These things are readily convertible into cash and there's an insignificant risk of value change. So if you think about you buying shares in a company, short-term commitments, you could buy and sell and you could be out of that in a second. Readily convertible into cash, if the market's liquid, then yeah, that's fairly easy. So sort of shares actually tick off those first two boxes. Insignificant risk of value change. Well, that's probably not the case with shares. What happens if you have currency of another country, but that currency's inflation rate or the way that its currency is being devalued might be quite high? And certainly currencies have gone through periods of quite heavy changes in their value. So you could actually have something which is cash. It's a short-term commitment, it may be readily convertible, but that cash actually may have a significant risk of value change. So depending on the country in which the nature of cash you hold, that may actually not necessarily be cash. So for our purposes, we're going to keep it fairly simple with what cash is, but it's not always straightforward. If you move between cash and cash equivalents, those aren't included as cash flows. Paragraph 6 talks about what operating, investing, and financing activities are. And we have to report by operating, investing, and financing. So we have to put it into those three buckets. And at that point, we'll take a short break. And we'll come back, we'll look at the different types of cash flows, we'll go through the practical question that we've got, and we'll wrap things up. So what we're looking at now are the components of the cash flow statement. We'll run through them. By and large, they're actually fairly straightforward. There's a few things, though, just to take note of as we go through. So the operating cash flows, not surprisingly, give you a sense of what's going on with the operations of the business and give you a sense of their cash generating ability. Money that you're getting from sales, what you're paying to suppliers, paying to employees, paying in tax. So those things are relatively straightforward. Moving a little bit just to the analysis side of things, whether or not you'd want to see a positive or a negative cash flow from operations, look, ultimately, you're going to want to see a positive number, but it depends on the life cycle of the firm. If the firm is fairly new, if it's a startup, you're probably going to see negatives in those numbers, or not very big at all. But you would like to see ultimately the firm generating cash flows in this particular space. The investing cash flows, expenditures on resources to generate future income and cash flow. Basically speaking, that is your investment in fixed assets, so property, plant, and equipment. Are you buying fixed assets, so you're expanding operations? Are you divesting yourself of fixed assets? Are you getting rid of property, plant, and equipment? Now, positive or negative, on its own, you can't really tell. What you need to then look at is what are the economic conditions? What does the company do? What is strategically how it's placed? So, for example, how many people? Actually, it'll be interesting to see how many people own up. How many people own a pair of Crocs? Yeah, the shoes. No?
Not a Crocs fan.
I don't think many people. Well, actually, surprising. It's like one of those things, no one will own up to it, but they used to sell lots of them. So people out there, they exist. But a few years back, things were going gangbusters for them and they started investing in production and production facilities all around the place. And then the market just bottomed out. So just because you're investing in expanding doesn't necessarily mean it's a good thing. Have you screwed up the market position? Have you screwed up what's going on? Did the economy just fall down? So it's not necessarily in itself expanding capacity a good thing. Depends what else is happening. Same thing, selling off property, plant, and equipment. Ultimately, once you've sold everything off, you've got nothing else to produce with. So it's not necessarily a good thing for that either. It becomes a lot more strategic what you're looking at. Financing cash flows, basically, apart from where you're generating funds from selling off property, plant, and equipment, or generating sort of retained earnings, this is where you get your money from. Are you going to the market and issuing shares? Are you going and borrowing money? If you've issued shares and if you borrowed money, are you buying back those shares, or are you repaying that money? That's basically what financing cash flows, the idea behind it. So those three sets are fairly straightforward. I just want to pick up a couple of things where it's, just to be aware of where it's a little bit different. So the reporting of cash flows. In first year, you do talk about the direct and the indirect. First year? That was like years ago. What? So you do talk about both. Now, we are only going to do the direct method in this subject. Now, the reason for it is I prefer the direct method. That's not the only reason. I prefer the direct method. I think it's a little bit easier and a bit more self-explanatory. The other reason is that even though, as of about 6 years ago, Australian companies were afforded the choice. So prior to about 2008, 2009, Australian companies had to choose the direct method. They were then allowed to choose both. And I know about this because I did some analysis of it with some colleagues here. Only 7 or 8 companies over the 4 years subsequent when we had a look at it, only like 7 or 8 companies actually chose to move to the indirect method. So everyone pretty much, and it may have changed in the couple of years since, but pretty much everyone that we've seen in Australia uses the direct method. If you use the direct method on the face, so on the actual cash flow statement, you have to show an indirect reconciliation behind. If you choose the indirect method on the face, you don't have to show anything behind. So it's kind of like direct and indirect, or just the indirect. And even that, everyone pretty much uses both. So that's what we're going to use. So that's just for the cash flow from operations. The main difference, just to spark memories, so it was Alex that I sold something to. So it's the starting point which is the difference. So for the direct method, the starting point is 0. So I sold, I can't remember, was it $100? I sold $100 worth of product to Alex. I would show cash flow from customers $100. So that would be my starting point. The indirect method has a different starting point. It starts at net profit after tax. So let's just change. I've sold Alex $100 worth of stuff, and he's only paid me $95. I would then take that net profit after tax, which would be showing $100, and I'd adjust that down by 5. So the starting point is different. It's starting at profit and then making adjustments for the difference between cash and accrual effects. I prefer the build-up so that you see I actually physically got this much money from someone, I paid out this much money from someone. Other people do like this idea of, okay, here's profit, here's cash flow from operations, and we can see the differences between the two. Suffice to say, regardless of which one you prefer, even if you prefer any, that's the one we'll be doing. Reporting of cash flows, we use gross receipts and payments. There are exceptions to that. For those of you who pay rent, if you're paying rent to a landlord, so if you're paying rent to the agent and not to the actual owner of the property, you'll be paying money to them, and then they'll be paying money to the owner. So in situations like that, you'd actually net out some of those cash flow effects. So you're not showing, you paid $200 and then they paid like $190 on. They'd just be showing the kind of positive 10. To make sure I've got the number correct. So it's not always gross receipts, but it generally is. Where it starts to become problematic, so this is something to be aware of for us. It's also something to be aware of down the track, is there are certain items which aren't always as easy to place, and interest and dividends are some of those. And classification, how you classify something, is actually quite a difficult thing in all events. Now, just to give you an idea from a personal point of view, not surprisingly, because I'm an accountant, I keep track of what I spend, because it is a good thing. I even have budgets of things and I'll kind of pseudo-classify them, but then you get situations which actually become kind of difficult. And I'll give you an example because it happened a few weeks ago. So StuVac week, after the exams when I wasn't marking papers, other people that work for me were marking papers, I went on holiday for a week. Now, I have my holiday budget, and I classify things as holiday spend. I also have my food budget, and I classify things as money, stuff I go spend down at the groceries and whatnot. When I'm on holiday, I spend money at the supermarket because we just went up to Port Macquarie. Is that a holiday spend or is that a food spend?
Only partially.
Well, I don't know. I mean, but that's it's a flipping idea.
Get any business done?
What's that?
Get any business done?
I didn't, so there's no tax effects from that. But
No, it's just different.
it is different,
Like
but I suppose the point is classification is not always easy, and you can have things which, is it part of the holiday budget or is it part of just this is my food budget? I don't know. And at some point you can kind of go, well, does it really matter? Maybe for me.
You are such an accountant.
It will get worse. Trust me. Just give us a few.
I do the same.
No, give us a few more slides. It will get worse. Look, really, for me, it doesn't actually matter that much. But when you start looking at people making decisions on things and choosing buckets, in this case, it can actually have an impact. And so it's just to be wary of this. So interest, they don't define which one it goes in. Interest could actually legitimately be placed in anything. If you've borrowed money for working capital to buy inventory and whatnot, arguably speaking, that's related to your operations because you couldn't function as a business without that, or you've taken out overdraft to do things and the interest costs for that relate to the operations of the business. So arguably that interest cost is operating. Or, what's the next? Operating, investing. Or that you borrowed money to buy property, plant and equipment. Is that relating to the purchase of property, plant and equipment? That seems like an investing cash flow. Or is it you've borrowed money and borrowing money is a financing cash flow, so the interest related to that borrow is financing. So they actually say you could actually just pick whichever you choose as long as you're consistent. The upshot of that is you can't just blindly take one company's cash flow from operations, and a lot of the analysis that people do, they won't look at the actual annual statements themselves. They might just get the machine readable information and just get cash flow from operations is X, financing cash flows is Y, investing cash flows is Z, and then just go compare this company's to this company's to this company's. But some of the things within those items may be different. So in company A, investing or interest may be in operating in company B, interest may be somewhere else. So you just need to be aware of that. Same with dividends, same even with tax. So paragraph 35 says you generally put it in operating, but it could go elsewhere. With subsidiaries, dealing with ABC, any aggregate cash flows in relation to acquisition or disposal goes in investing cash flows. We're not really dealing with this so much, but any analysis you do, so that analysis of acquisition, the details of it, that does go in the notes. So you're explicitly required to put that in. If you come across it, it is interesting to sit down and read some of the information in those things. You kind of wonder why they put this in, but non-cash investing and financing transactions are excluded. And you kind of go, well, really? Of course they're going to be excluded. It's non-cash. We're dealing with the cash flow statement. Reconciliation of cash flow statement and balance sheet. So they do talk about how we see the fit between what we saw with the cash flow statement and the balance sheet. So you'd like to see, hopefully not you've left in a note saying I've got to fudge this to make sure it all balances out, but you'd like to see everything match up, which is basically what paragraph 45 is saying. And other disclosures, unused facilities. Is anyone aware what unused facilities are? Well, you do, but okay. What they basically are is if you're going to get a loan, so imagine, and I've started getting letters for credit cards again, so obviously people are starting to get, whether debt's becoming a little bit cheaper, but credit cards, if you're getting a mortgage, car loan, personal loan, whatever, they're going to ask you, and if you've got a credit card, it filled in a form before, if you've got any sort of loan, you'll know this. But they'll ask you a number of questions, including what your income is, what your general level of expenditure is. So that's pretty much your profit, in a sense. They're going to ask you what your assets are. Do you have cash and investments, whatever. They're going to ask you what do you currently owe. So if you have other loans, if you've got credit card balances existing. They'll also ask you what your credit card limit is, which is basically, and so we'll get to what an unused facility is in relation to that. So for example, let's say I've got a credit card and I have $1,000 on balance with it and I've got a $5,000 limit. They want to know the $1,000 that I owe because that is something that is a current liability that I currently have because I actually owe that. But they also want to know the fact that I have $4,000, then my limit is $5,000, so they can work out that the unused facility is $4,000. So my question to you, and one or two people are going to be excluded from this, you know who you are. Why do you think they want to know what your limit is? Not just what you owe, not just the 1,000. Why do you think they want to know the 5,000? Yeah, I could be more in debt with that. Because what does that, when you get a credit card, and for those that do, what that is basically saying is the bank has said, we are authorizing you that you can spend up to $5,000 and you don't have to get any more authorization to do that. So I've got that credit card, I could, go off and just withdraw $4,000 in cash probably over a couple of days because I think the ATM limits stop it. I could just go off and do that and I don't need authorization. I could go and buy a business class ticket, maybe not to London, I think it's probably a bit much, but I could just go off and splurge on it and I don't need to get any more authorization. And so the concern is from a user's point of view, if you have that limit and you have this unused facility, why are you then coming to us to borrow more money when you could already use that right at this point in time? And with credit card debt, it's pretty bloody obvious because that has about a 20% interest rate. So of course you're going to use a cheaper form of debt if you want to do something else because you're not, or you shouldn't be funding things with credit card debt because it's just one of the most expensive things outside of payday loans that you could do. So that's what an unused facility is. It's not a cash flow, but you do need to disclose it. Now the practical example, a little bit of a precursor to it. This is very much around problem solving. And in some level, that's actually quite a useful thing. I mean, the ability to take information and solve problems and figure out solutions to it, regardless of an accounting or something else, that's actually quite powerful. You guys have accounting knowledge. You then need to kind of put this into practice with what we're going to do here. Now, there are a couple of ways that we can do this. This is what gets used in the textbook. And it's what's called, they call it the formula method, because, and you'll see it through the textbook, and it's not the only method they use in there, but they definitely do have formula in there. Not those formulas are something completely different. Now, this is my 2 cents. You can take it with a grain of salt, pinch of salt, grain of salt, I always get confused. You can take it with a grain of salt. I would absolutely advocate not using the formula method because it is just additional stuff that you need to remember going in. It's easy to just get, do you need to plus something or minus something, and that can, you get one of those things wrong and you're stuffed. It also doesn't allow you to see if you're on the right track. So look, if it's a method that you can use and you're happy with using it, it makes sense to you, I'm not standing in your way, I'm happy for you to use it, I would just advocate not. The second method is you can use computers, and realistically that's how it gets done. Look, in practice you're not going to be sitting there doing this on pieces of paper, you're going to be using spreadsheets, you're going to be using programs. But we are not at the point yet where we have exams, where we have computers in assessment centres, so that's out for us. Now the third method is called, what they call the reconstruction method. Now this is a method I would advocate, and it's going to be using T accounts. For those that haven't looked at a T account for a while, we are going old school with this. Now, just to give you some background before getting into this, for those of you who are interested, and hopefully this doesn't put you off, but for those of you who are considering sort of CA and CPA and those sort of things, I can speak on the CA side of things, being a CA. But the financial reporting module as part of the CA program, you will see all of this again, because the financial reporting module is ASR and ABC combined. I've gone through it, I've seen what's in there, it is basically the same material. So maybe don't throw all of this stuff away. Don't forget about all of it. It will kind of crop up again. Now, they actually advocate this method as well. And it's a good one because it allows you to, in a way, a couple of things. One, it allows you to get under the hood and make sure you're comfortable to see how things work and sort of piece things together. The reason I like it is because it's graphical. You get to see, and it's very obvious when you've done something wrong. Now, why it's called the reconstruction method. Now, you thought my last example was bad and I'm such an accountant. This gets better. The way I see this, and I don't do this all that much anymore, gotten old, hit 30 a while ago, don't go out too much anymore. Now, but you know, when I do like to keep a record. I do like to have an idea of what I spend when I go out. Being an accountant, that's kind of what I do. Now, a bad way to do that is to try to keep track as you're buying drinks and as you're doing stuff. You're like, yeah, I spent that, and that's not going to get you all that far, especially after about an hour in. And it's not going to really come across well with the group that you're with. So that's not a good way to do it. So what I do, and I still do this, I was just on a Bucks party a couple of weeks ago, and what's that?
Pay by card.
That comes into play. Oh, sometimes you can't pay by card with everything. Sometimes that's a dangerous thing, starting pulling out the credit card. What's that? Yeah, and that's why it's a dangerous thing. But no, this is actually a way to do it without, and if you can pay cash. So I will write down at the start of the night, before I go out, how much I take out in my wallet. So, you know, $100 came out with me. Then the next morning, look through my wallet, look through sort of pockets. Oh, look, I've got $80 left. I spent $20. Sweet, decent, you know, good night, and didn't seem to spend all that much. So in a way, you're reconstructing what happened from the night based on your start point, which is $100, and the $80 that you left with. And then you find out additional information. Then you look on your credit card statement. Then you look on your bank account and you go, hang on, I would do $200 during the night. This is starting to add up a little bit. So we're feeding in additional information. So the way I like to think about it is the reconstruction method is kind of like the hangover method for doing cash flows. It's trying to piece together what happened based on certain information that we have. And you will get more and more information as you go through it, and you can start to build up a better scene of what occurred. You can assume things. Maybe not exactly what happened here. You can assume things, but it's sort of building up this idea as we go through. So this is the starting point. We could have this and this alone, and we could do stuff with it and create a cash flow statement, but we have additional information. Now, first thing, make sure you get the years around the correct way. So year 1, that's the opening balance. Year 2 is the closing balance. So ultimately, cash went from $100,000 to $100,200. So that looks like nothing happened. And that also gives us a reason as to why a cash flow statement is useful, because if we just look at that and you go, well, we have $200 extra in cash, it doesn't tell us an awful lot. A whole bunch of stuff could happen and it could have very much netted out. So we need to see a little bit more what's happening here. And the way that you do this, the best way to think about this is to be systematic going through it. This additional information it's not exactly, but that could, by and large, be housed within a profit and loss statement. You know, some of it not so much, but generally speaking, it's housed in just dot points at this point in time, but it could be housed in another setting. The key thing that you guys need to take away from this is we have information about these things, and you just need to be systematic. So when you get something on tax, and you're looking for the tax cash flow, look for anything which says tax in the information that you have. So anything on that page 1, look where it says tax and use that. So we're going to look at cash flows from operations first. Now, the really nice thing about cash flow, actually just cash flows in general, is, this may be pushing my luck. Does anyone have a copy of the standards with them now? Yeah, I thought it'd be, yeah, look, and that's fair enough. I can't even, I just have to carry them up from the office and I'm too lazy to do that, so I can understand. In the back of 107, there's actually an appendix item which gives you the template for a statement of cash flows. So what you see sitting down on your page 2 all of that information is actually, apart from obviously the numbers, but you actually get to see that. So you don't need to remember all those items. You can just have it sitting there. What we're trying to do is fill in the numbers. And it's just systematically working through the accounts which are linked to these various things. And that's all that we're going to do. I'm not going to flick back to page 1 because it'll just get a bit tedious. So while I'm doing this, keep an eye on page 1 and the information that you've got there. So the way you set this up, so reconstructing, we're looking at opening and closing points. So customers, what we're dealing with customers are a couple of things. We're dealing with accounts receivable because that's what, if they don't pay us up front, we're going to be getting a receivable from it. And we're dealing with sales revenue. In a more complicated answer, you may start to have to deal with bad debts. So, you know, the expense in relation to bad debts and bad debts allowance. So there are other accounts which may feed in. In this case, it is very simple. And all that we do is put in the known information. So accounts receivable. You go to the balance sheet and we start with 72,230. We end with 106,860. If that was all the information that we had and we ended at that point in time, it looks like we've sold $34,000 worth of stuff and no one has paid us. But that's not what's happened because we have that additional piece of information which tells us how much was sold. So we know we have 301,000, where's sales revenue? 301,330. And that would be debit accounts receivable, credit sales revenue. And if you look through any other information about customers, there's no bad debts, there's no allowances, that's it, that's all that we have. And so what we have there is an account receivable balance which should be 370,000 or so. But instead, the closing balance is 106. That means we have collected. And what we've collected, good idea to double check that the calculation is correct. That would be debit cash, which is what we've got here, credit accounts receivable, and that's the 266,700. So everything in red here is given. It's just literally a matter of putting it into place. And what is left over, you can assume is the cash flow. Yes, it could be that you've written off 266,000 of bad debts, but if we haven't told you that, then you have to assume it's the cash flow. And that's what we've got here. So what I might do, just to change things around a little bit, because you've now got the sense of how this works. I'm actually going to get you guys, I'm going to set out the T accounts. I'm going to actually get you guys to do this. I'll change the color again, screen, and I'll give you I'll give you sort of a start with the numbers, with the accounts that we need. Okay, so the accounts that we're dealing with for payments to suppliers in this particular example, we've got, where is it? Accounts payable. We've got inventory. We've got cost of goods sold. And we've got one more, sales and admin expense. Okay, so what I'm going to do, it's going to mean you guys have to put your thinking caps on for a moment. So those are the 4 accounts we need to use, and we will need to use all of them in this case. What I want you guys to actually do is spend 2 or 3 minutes and just feed in the given information that you've got, and then try to work out, and you actually have the solution there, so you should be able to sort of match it up with where you're meant to go. Spend a couple of minutes and see how that all links together, because I think it's a lot more useful if you do it rather than me explain it again. And we will go through it together, but You guys have a crack first. Together. So hopefully you've had a crack at this. Yes, you got it? Beautiful. Okay, I'll go through. It does work a bit better if you've had a go at it, so hopefully you guys did have a go at it and didn't figure out what you're up to on the weekend. So it's just, let's put in all the known information. And so that's the best way to start these things. So accounts payable, we start with 87,810. We end up with 103,690. Inventory, we start with 90. And we end with 95. Cost of goods sold, there's no opening and closing, it's just a one-off sort of thing. And cost of goods sold is debit cost of goods sold 50. We need the credit for it, we'll come back to that. And sales and admin expense is 47,630. It's good once you've used a piece of information, like draw a line through it. So, you know, you can knock off item 7, you can knock off item 5 and so on. So cost of goods sold. So this is a known piece of information. We debit cost of goods sold and we credit. What do we credit in relation to cost of goods? So we debit cost of goods sold. What gets credited? Inventory. So that comes down here. When we debit sales and admin expense, we can assume, we could have paid that in cash, but let's assume that we went and put that in accounts payable. So that's just all the big lump sum accounts payable. Okay, so that's just off the known information. We know we had an opening and closing for inventory and accounts payable. We've seen a COGS effect and we've seen sales and admin. So we've done nothing other than just piece it in the right places. Then from that, we can start looking at the calculations that we need to make. Pointer options in color blue. Okay, work. Okay, so inventory, 90,000, 90 minus 50 gives you 40,000, and that's not what the closing balance is. So which means we've purchased inventory across that period of time. And so we've got a debit 55,000. And that means we're going to put that, it could have been a cash purchase, but we're going to assume it went through accounts payable first. And so we have accounts payable of 87,810 plus 47,630 plus 55,000. And if you look at what those three numbers add up to, and hopefully you did something like this, that would add up to 134, about 189, something like that. So it'd be about 189,000, these three. That's not what the closing balance is. And so what that difference is is 86,750. So we've worked through, we've just put the numbers in, and as you can see, the only thing we have to actually make a calculation for is a 55, and once we put that in, it just falls out and we figure out the 86. So it's just a matter of taking the information and just putting it in the right places, which is why I much prefer this method, because it allows you to see that. We just made it. So that is using the T account or the reconstruction method for payments to suppliers.
Excuse me.
Yep.
Sorry, where's the 55,000?
It comes from the 90 minus 2. So you know you started with this,
Right.
and you sold that amount. So if you hadn't bought anything, you would have had $40,000 left. But we know when we did sort of stock take at the end, we had 95,000. So it means that we purchased 55 during the year. So that's where, that's where it comes from. Cool. So while if you're having a look at that, but just in the interest of time, interest and tax for this particular example are straightforward. Because if you turn to page 1, if you look at comment for interest, if you look for comment 6, interest expense and all of that was paid was $20,000. We have told you explicitly that number is given. If you look through the balance sheet, there is no interest payable account. It is, sorry. Okay, that tax is given as well, but that should have been one up. It's annoying. Where is it? So that's given. And look, there could have been a tax, if there was interest payable and that interest payable balance changed, then yeah, you've got to make adjustments for it, but just look at what information you have. Ditto with tax. Income tax, point number 4, income tax declared. I don't think it should be declared, but expensed. Income tax declared and paid during the year was $5,000. You've just got it up there. So that was just the tax paid. Now, for tax paid, that could get a lot more difficult. You could have deferred tax assets and those amounts change. You could have deferred tax liabilities and those amounts change. You could have a current tax liability, those amounts change. So we've got a very straightforward one, is just we've had tax, we've paid it. But it could be made drastically more difficult. So just again, be aware of that. And at the end of all of that, once you've worked out these 4 items, gone missing. Once you've worked out these 4 items, put them all in, you're going to get 154,950. Added them up, that's your cash flow from operations. So cash flows from investing activities. This is just dealing with property, plant, and equipment. If you had multiple pieces of property, plant, and equipment, you'd have to just repeat this process. But what we're doing here is, again, just looking at the accounts that we have, and we don't, in this case, I'm going to put them all in, but we don't necessarily need them for what we're doing. PPE, we need accumulated depreciation, and just for completeness, depreciation expense. But if you had revaluations, if you had other things going on, you just, everything related to PPE, just put up the account. Once you get used to it, you can leave ones out because you know what happens with them, but it's good just to put everything up. And then it's just a matter of putting in the information that you have. So property, plant, and equipment, you have an opening balance of 483,550. You have a closing balance of 511,470. You have accumulated depreciation, have an opening balance of 167,230. You have a closing balance of 185,710. Depreciation expense, we have no information at this point in time for it. We may not need it for this example, but at this point, that is from the balance sheet and some of the profit and loss statement, the information that we have. If that's all that we knew, this has gone up by 28. This has gone up by 17 or 18, and we don't know what this is. So if this is all that we had, it looks like we've had depreciation expense of about 18,000. It looks like we've had something increase property, plant, and equipment by 28. What ways can this account be increased? You could have a revaluation is one, or you can buy new assets. So if you haven't been given no information about what has caused the change, assume it is a purchase and assume it is a purchase for cash. And that idea about cash, if you see a change in an account and you are not told what's caused it, assume it is a cash effect. So if you've seen, the accounts payable has changed after all the other things, that's you've paid off people and so on. There is some more information that we have though for this question, and that other information is note 1. Property, plant, and equipment originally costing $50,040 was sold. So that means we know that this has happened. And the carrying value of that was 6,150 is the carrying value. And that's it. That's all that we know. So based on that, property, plant, and equipment, should have had a balance of about 430 odd. So it's 480 minus the 50. But this is what we ended up with. And this is the purchase which has happened. So again, everything I put down there is just information from the question. So this minus this would give you about 433, but we need to be up here. And so we need to have some sort of increase. And just mathematically, that increase is 777,960, which is what you see up there. Because we purchased property, plant and equipment, we've assumed it's cash. That means cash is going out. So that's the only thing that we've done there in terms of calculations, apart from just putting information where we know it needs to be. That's it. That's the only thing we've actually had to kind of work through. Now I'm going to ask you guys, how do we know the answer for proceeds from sale is 7,150. How do we know that? From the information that we have, oops. Yeah, it's written there. Like in this case, this thing goes missing. This is given. If you read through that note 1, it says the property, plant and equipment originally costing $50,040 was sold for $7,150. So that's pretty important. So it was sold for. It would be different if it said it was sold for a profit of $7,150, because then you would need the carrying value to be able to determine that. And in this case, because of the information in the questions we have, and that's not always going to be the situation, we actually don't need to know what this is, and we actually don't need to know what's going on down here. But you can see how if you know this and you know the carrying value, you can figure out what this number is. And if you know what this number is, you know how to get what this number is, which is what's down here. It is possible very quickly to figure all that out, but you don't need to here. So we're not going to do that. Okay, the last one, this setup is really straightforward because the information that we have is relatively easy. And just for keeping the method going, I'm going to put up all the accounts, but realistically for this one you don't need to do it. So I'm going to come back to dividends in a second. So for, what have I called it, debentures? Debentures and shares, just simply put down, simply note what the balances are. That's it. So debentures starts with 97,610 and we end up with 84,390. Shares start with 156,870 and we end with, where is it? 157,430. Opening balance, closing balance, closing balance. And then all that you have to do is look through the other information that you have about debentures or the debt or the shares, and what you found is that they say nothing about them. They don't say that you issued property for shares, they don't say you had a bonus share issue, they don't say anything about the debt. That's it, that's all that you know. And that simply means whatever is the difference between these two is what you need to do. So with the debentures, it's gone down, so we need to go over here, 13,220. So we debit debentures, credit cash, which is why this is a cash outflow. And with shares, it's gone up ever so slightly. I mean, obviously that's not realistic. Like, you wouldn't be issuing $560 worth of shares for cash. It just could happen, but it doesn't really make sense. So shares have been issued, so debit cash, credit shares, share capital ultimately. So we've got payment of borrowings and proceeds from issuers of shares. And to finish up with, I'm going to do it one way, but then I'm going to put it on you guys to figure out how you do this. Because we've been, with the dividends, we've been relatively, this is easy from the information that we've got. So if you look at note 3, dividends declared and paid during the year, I'm pretty sure that should be were, but anyway. Dividends declared and paid during the year was $71,280. So we've just told you that that is what has been paid. So this information up the top here, find it, got lost again. That's given. And that's from note number 3. Add up all those effects and you end up with a cash flow from financing activities of an outflow of $83,940. Now, something to put your accounting knowledge to use. If you've got the answer, you figured it out, just keep quiet for a moment. I'll give you guys a minute, shouldn't be more than that. If you're going to take longer than that, there's probably something you need to come back at. If we were to give you the same set of information, so everything on page 1, just keep that as what it's there. But if we did not give you note 3, you can still work out that number. So you're already like, okay, so you're already like 1,000 steps ahead. I want you guys to figure out how you would calculate 71,280 if you were not given note 3. Right. So what is the account that we should be looking at that will tell us, that will assist us in that? Retained earnings. So if you're thinking along retained earnings, that's exactly where you need to start looking. So look at the opening and closing balance of retained earnings. Right. Retained earnings. And retained earnings starts at 236, 260, and it ends at 282, 310. So what do we do with that? Add net profit, and net profit gets added to it, and we know net profit was 117,330. And what we see there is, because retained earnings gets affected by net profit, so you add profit in, and where do dividends come from? They come from retained earnings. So we can see that 236 plus 117 does not equal 282. It's 300, 340, 352, thereabouts. Looks about right. The difference between what we've got here and what we've got down here is, if it's all been done correctly, should be 71,280. So that's a way that it could be done without explicitly giving you dividends. So don't always expect that things are going to be explicitly said, because some things, it could be done like this, where there's no other assumption. Like we're not making an assumption it could be like a revaluation or a purchase. Like this has to be, that's what's happened. And put it all together. Operating, investing, financing, show the net change, show the start, show the end. And as I said, that template is in the back of 107, so you will have something with you. Blank page. We've hopefully understood what cash is and the implications of what cash flow statement, why we actually have prescriptions for disclosure. They provide different information, they provide information which is useful, and it is predominantly about classification and presentation. And thank you. That ends the content for the subject. Next week, as I said, is a revision lecture. I hope to see you there. If I don't, good luck for the exam. Remember, next week is the bonus assignment. Other than that, good luck.